Something you said in your notes ahead of this appearance that jumped off the page to me, and I want to ask you this question. Is it a mistake to infer broad strength from the data we're seeing in the labour market right now?
Absolutely, because we came out of this pandemic with a real shortage of labor supply for lots of, demographic reasons, immigration reasons. So you ended up with this huge excess demand for labor, which is generating this payroll growth. But meanwhile, at the end of this month, according to the Atlanta Fed, they believe we'll print a negative GDP report for the second consecutive quarter. Now, I'm not quite there, but this strong CPI report for June will bring down real retail sales, real consumer spending for June. So that gets me closer. I do think that GDP overall will have shrunk in the first half of 2022, which will fit a traditional definition of two consecutive quarters giving you a recession. So I think we're much weaker than the employment report tells you. And it's just an artifact of this weird labor market through the pandemic that gives you these payroll job gains. But there's a lot of weakness and there's a lot of pain out there. When you look at those higher food prices, higher gasoline prices, that's why consumer confidence is at a 50-year low. So I think there's a lot of weakness there. And the Federal Reserve just needs to recognize we're going to go through a cycle here. We're going through a cycle on unemployment, go through a cycle on inflation. But it's stupid to push rates up to 3.5%, 4%. in the knowledge that you're going to have to cut them next year, and you're basically just setting up an artificial cycle. And history suggests the Federal Reserve is not good at micromanaging the economy in this way. So they shouldn't go too far now, because they're just going to have to reverse themselves in 2023.
David, you've just said what they shouldn't do. Is that different to what you expect they will do?
Yes, I think they'll go 75 basis points, and they'll put out a lot of hardline rhetoric about raising rates. The dollar is already at almost a 40-year high in real terms. That's going to hurt our exports. It's going to hurt the housing market. But I think they're scared of looking weak on inflation, and unfortunately, this report is going to just give fuel to the hawkishness of their commentary. But I remember a time when central banks used to be forward-looking. They recognized that monetary policy works the lags, that inflation is a lagging economic indicator. So you should set policy for where the economy is going to be, not where the economy is right now. But that doesn't seem to be the doctrine of this Federal Reserve, or the last one for that matter. So they're going to react to hot inflation today by being very aggressive later on this month.